Hello, 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 and welcome back to the Run the Numbers podcast. So, last week we had the pleasure of breaking down Figma's S1 as they filed to go public. This week I want to talk about the opposite of that, and it's the shrinking public markets. And what's attached to that is the rise of private credit in the background that's allowing companies to stay private for longer. So, what we're going to do is we're going to dive into the number of companies that are listing to go public on either the NYSE or the NASDAQ, as well as the trends around funding. And if we're just going to be living in a world where some of the best companies are kind of sequestered off to the side and the value is squeezed out of them by whoever's able to get in when they're still private. So, this is an interesting trend for anyone who's looking to work at a company that's still private with the hopes of it going public someday, or if you're looking to invest. Not that this is an investing podcast. I just had a peanut butter and jelly sandwich right before launching into this monologue, which is never a safe thing to do. So take it from one guy. We're going to dive into that after a short word from our sponsors, Campfire. And guess what? They sent me all the gear to have a bit of a bonanza, to have a campfire in my backyard, a picnic of sorts, a picnic under the stars. And it came with a set of s'mores. And me and my wife were like, "Oh, this is so interesting. They sent us this nice marine layer blanket during the summer. I guess we'll get some use out of it in the winter." And they sent us these s'mores, which my 3-year-old gobbled up for breakfast instantly. And it took us about 15 minutes because we're not that smart to figure out that it was a play on words. It's to have a campfire. Get it? Because they are campfire. Okay, I'm gonna shut up. Roll the ad. If you've ever lived through an ERP migration, you probably have the scars to prove it. Those migrations are horrible, and they have endless consulting fees. And even after you're live, getting simple answers still means hours in spreadsheets. I can't tell you how many times I've exported from an ERP to a spreadsheet just to figure out what I should have been able to figure out in the ERP itself and do my own back of the envelope math. But Campfire fixes that. It's the AI first ERP built for modern finance and accounting teams. It's helping mid-market and enterprise teams close faster, unlock insights instantly, and scale smarter without the additional headcount. And I know this because I actually use Campfire myself. It's what we run mostly media on, and it's been a game changer for our finance workflow. The interface is intuitive, migration was quick and painless. Seriously, their team is incredible, and it's freed us up to focus on actually making media. And they just raised $35 million from a sell to further reimagine the ERP, one of the best investors in the game. And that's not an easy undertaking, right? These guys are doing something very bold. I'm so excited to see how they keep reimagining the space, and you should be too. Check them out at www.campfire.ai. That's www.campfire.ai, and get on the same ERP that your boy's on. So let's talk about that club that you thought you wanted to be a part of. So over the past 30 years, the number of publicly traded companies in the US, it's been roughly sliced in half. It's fallen from a peak of 8,000 in the late 1990s to just 4,000 today. And that stat shocked me because I knew that IPOs were a slow drip, but what I didn't realize is that the number of companies being taken private is far outpacing the number that are actually joining the New York Stock Exchange and NASDAQ ranks. And so we have had brief spells of exuberance. If you remember Chamath saying, "That is below my line," that will forever be the image that's ingrained in my head around the ZERP era of 2020, 2021. But the long-term direction it's really clear that fewer companies are going public and either fewer are staying public. And the public markets are becoming like less the promised land and more this gated community with really high HOA fees and annoying neighbors who keep telling you to take your yellow bench inside. And Lisa and George, if you're listening to this right now, I know that you complained to the HOA again about my bench. They showed me the email. Snitches get stitches. But in our internal tracker of now 140 publicly traded tech companies, the average market cap is about 8.5 to 9 billion. And among the top 10, as measured by enterprise value to next 12 months revenue, as a multiple, the median will jump to about 58 to 60 billion. With the assets that remain, the public markets are definitely skewing larger and larger. So you don't see a ton of these 1 billion to 3 billion market cap tech companies anymore because honestly, like the economics and the attention and the mechanics just don't support it. So if you're a smaller market cap company, it's hard to get in and even harder to get out for investors. So you have to think like a large fund they'll struggle to build or exit $100 million positions in small cap stocks without like totally shaking and moving up the market. And so low liquidity will mean thin trading volume, and it makes it risky and difficult for them to unwind positions quickly or quietly. So that's one reason why it's hard to be small. Another is it takes the same work, about the same work, with lower visibility and reward to cover one of these stocks. So if you analyze a small cap stock, it's going to take just about as much effort as a large cap name. It's not like you can cut corners there. It's just a smaller company, but the payoff isn't always proportional. Limited analyst coverage, that ends up meaning fewer eyes in the story, while ownership disclosures can telegraph moves to competitors before investors can act. So those aren't great reasons, right? If you're smaller. And what we're seeing is that the private markets have really grown up. So if you look back at how we got here, I found three structural shifts over the last 30 years that fundamentally changed optionality in your capital stack. So the first was this policy door open. It was called NSMIA in 1996. That's the National Securities Markets Improvement Act, which sounds like a foot fungus, and it reshaped the fundraising landscape. So it basically made it a lot easier for companies to raise private capital without registering with the SEC. And it's no coincidence that the number of US public companies peaked then in 1997, just a couple months later. And from there on, the listings crept downwards as venture capitalist and private equity fundraising boomed, because remember, now it's easier to raise capital. And that helped companies stay private longer. The second one is the private credit boom. Over the past decade, private credit has exploded. And I didn't realize it because it's exploded, but it's been quiet, at least from where I sit. Assets under management rose from 300 billion in 2010 to 3 trillion by the end of 2025. That's a forecasted number. And unlike traditional bank lending, private credit, it offers tailored terms, faster execution, and fewer operational hurdles. Now, it does cost more. It will usually trade at about 200 basis points above traditional syndicated loans, but it does give sponsors and operators the ability to fund growth without diluting ownership or dealing with the friction of public filing. So it's just another Jenga piece in allowing companies to stay private longer. So you got the rise of venture funds, private equity funds, private credit. And then in 2012, the Jobs Act, that was like NSMIA, NSMIA, part deuce, because it raised the number of shareholders a private company could have from 500 to 2,000 before you trigger SEC reporting requirements. And so it sounds like a small tweak, but it creates this big unlock, right? Because companies can now raise multiple late stage rounds and support internal tender offers and delay going public without tripping over regulatory wires. So the pressure to IPO for cap table management alone was mostly removed. So the real question is, why go public when you can stay private? Going public, it means you end up signing up for a whole new operating system. And that means quarterly earnings calls, Sarbanes-Oxley compliance, Reg FD disclosures, and activist investor risk. And none of that is cheap. So there was this study by MEKETA, a lot of acronyms here, Maketa, and they estimated that an IPO raising over $1 billion can cost $150 million after you factor in legal, underwriting, accounting, and even printing fees. Pause there. Physical printing. Yeah, paper can be very expensive. Michael Scott, I hope you're listening. And so I wrote a recent breakdown of PagerDuty's IPO, and Howard Wilson, their CFO, gave me three core reasons to list. He said investor liquidity, enterprise credibility, and customer transparency. And even if those are like the big three reasons, is that enough, right? If the private markets keep evolving, we'll need to add a fourth, fifth, and sixth reason to the list to justify going full kimono. So let's get back to the rise of the private liquidity loop. So when IPO windows narrow, liquidity, it doesn't vanish, it moves like water. So that's where the sponsor to sponsor trade enters the group chat. And instead of a company going public to create liquidity, one private equity sponsor will sell to another. So example, KKR hands the keys to TPG, Vista trades to Insight. And this isn't theoretical. Over half of all private equity exit volume in recent years has actually come from these sponsor to sponsor transactions. You just don't hear about it as much. And the use of what they're called GP LEDs, because it's their general partner is trading to another general partner, it's not always about just wringing more IRR from a struggling asset. It's often purely about time constraints. And so in November of 2024, we had the privilege of speaking to Scott Voss, managing director at HarborVest, one of the larger participants in this market. And he said, it's not a function of quality, it's timing. If you're in year 10 or 12 of a fund and you've got a winner, you may need to find a way to hold it longer, even if an IPO isn't on the table yet. So if you're an LP in both funds, which many large endowments and pension funds will be, here's what that looks like. So you get a distribution notice from KKR, then a capital call from TPG. And at the end of the day, you end up owning the same company just in a different wrapper, which is interesting. So you've technically gotten liquidity, but your underlying exposure, it hasn't changed. It's financial musical chairs just with like a better IRR. So more recently, like I said, GP-led secondaries have stepped in as this more nuanced solution. And rather than forcing a sale, the GP rolls the asset into a continuation vehicle. A lot of companies who are listening might find themselves in a continuation vehicle. And that gives existing LPs the choice to cash out or stay in and brings in new capital to support the next leg of growth. And what Scott said on the podcast is we're not selling our company, we're creating an option. The original LP can cash out if they want or continue with the investment. It's a liquidity option, not a liquidity event. So TPG estimates the GP-led market reached $75 billion in 2024, which is half the size of the entire secondary market. I'll say that again because everyone thinks the secondary market is massive, but the GP-led portion, the GP-led market reached 75 billion, half of what the secondary market is at, and they're expecting it to grow to 300 billion or more in the coming years. And firms like HarborVest, Lexington, and AlpInvest are now structuring these deals at scale and building out dedicated continuation strategies. These deals have also undergone a very important perception shift. So Scott explained they started out as bad news solutions, old portfolios, tired assets, but now they're good news, good story deals. These are often strong companies that just need more time than the 10-year fund structure allows. And he's right. A lot of these secondary deals, people used to be like, oh, there's got to be some hair on that thing. But that's not really the case. There can still be great assets. I always find it super funny when people call a company an asset trading in these transactions. So the tooling finally is catching up to the desired capital flows. And the net result is that liquidity is no longer synonymous with IPO. The old playbook was go public or go home. I think the new one is becoming recycle the cap table, extend the hold, and just keep growing off market. So the credit markets have become this quiet third voice in the room. And in most liquidity conversations, it used to be just two players at the table. You get the company and the private equity or venture capital sponsor, right? And now there's this third voice, which is private credit. And they've gone from shadow lender to high leverage, no pun intended, terrible dad joke, a high leverage partner. And like we said, approaching 3 trillion in AUM, it now competes directly actually with syndicated loans and even replaces IPO proceeds in some scenarios. And we've seen this recently. Whether it's funding a recap or supporting a continuation vehicle or underwriting an acquisition, credit markets are central to how deals get done today. And I personally was not aware of this when I started my career. I thought it was raise equity funding, IPO, or bust. And that's why I'm trying to give myself this crash course and talking to you today about the credit market, because it's changing the jobs for CFOs and operators. So what does it mean for you? So we've entered a new era of capital markets, one where private is no longer a stepping stone, but it's a fully built out destination. So if you're a CFO or an operator, the implications, they're pretty clear. You must now hire credit quants in-house. No, I'm just playing with you. Mezzanine jokes aside, what does this mean? Fewer comps. So with fewer companies going public and even fewer staying public, benchmarking, it will become harder. You can't just pull a peer set off of Coifin, which is my personal favorite, and call it a day. You'll need to also triangulate value from secondaries, continuation fund pricing, and private financing rounds. So benchmarking continues to shift to more art than science. Next, more complexity. Liquidity no longer follows a linear path. Sponsor to sponsor deals, GP leds, tender offers, and structured credit all bring nuance and risk. And so understanding these tools is now part of the CFO job description. Calculated optionality. The decision to go public should now be framed less as a finish line and more as a fork in the road. You're not just evaluating market timing, you're weighing against credible private alternatives that didn't exist a decade ago. And that means new skill sets are required, right, guys? You need to know how to manage through secondaries. You need to understand fund mechanics, and you need to speak at least some of the language of both equity and credit sponsors. So, yeah, I mean, your job as CFO just got a lot more creative, because being private doesn't mean being static. It means navigating a more sophisticated, more bespoke capital landscape, one where liquidity is an adventure, not a single default path. Thanks for hanging out with me today and exploring the nuances of the private markets. And if you're thinking about an ERP that's built from the ground up using AI, check out Campfire.